In this presentation, we will continue on with our corporation comprehensive problem, entering the closing entries, entering the second of 4 closing entries within the closing entry process. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're going to enter our closing entries into our general journal, post them then to this worksheet. We have entered the first closing entry already. We have the adjusted trial balance. We're entering our adjustments in the middle column, and then we have our adjusted or our closing trial balance. As we enter this, I'm going to enter the balances over here to the right so that you can see the prior journal entry as well, so you can see it all on one worksheet. And then when we combine them together, we'll show it on one worksheet. So hopefully this makes sense for you. So if you're doing this by hand, in other words, we're going to have one account, this account, where we're going to have to add something new to it. We're going to have to change that number. I'm going to do that on the right hand side first, and then we'll see how it should all look together on one worksheet. Okay, so here we go. We know that the revenue or income has been closed out already. That's the goal of the first closing entry. We closed it out to the income summary. The goal of the second closing entry is to close out all of the expense accounts. Now this is the most confusing in terms of just looking at it because it's long, but the process is really easy. It's just like we did with the revenue, except that the expenses, all expenses, have debit balances. It's what an expense is. It typically has a debit balance and they only go up in the debit direction. So all we need to do is just take every expense that we have here and we need to make each of them go to 0 with a journal entry. And so we're going to take whatever balance is there and we're going to credit it for that balance. So in other words, the wages expense has $6,500 in it. We're going to credit it $6,500. Now you may be asking yourselves that I may be contradicting myself in some way by saying that we are crediting an expense account, which I've been saying we never do. And up here we debited a revenue account, which we never do. And you can think of that as one of two ways. One, you can think of it as the exception to the rule. We do that in the closing process, meaning income statement accounts only go up. And right now we're bringing them down. So I've always said the rules, they only go up, and now we're bringing them down. So you can think of that, well, the closing process is the exception where we bring them down. We do the opposite thing to them as their normal balance. Or you can think of it just as, the closing process is when we reset things, just like resetting a watch. So that, the time only goes up in a stopwatch until you reset it back to 0. So really this isn't really an exception to the rule. It's just we're resetting the stopwatch. Once the stopwatch is set, it only goes up, and then we reset it and then it goes back down. So that's what we are doing now. We're going to bring it down, but really we're just resetting the stopwatch to get to a new starting point. So we got the $6,500. Now we got the utilities, $1,300 debit. We're just going to do the opposite thing to it, crediting it. Supplies expense, $11,000. It's a debit. We're just going to do the opposite thing to it, credit. I'm just making our journal entry over here. We're just building our journal entry as we go. We're not worried about that it's not in balance or anything yet, because it's going to be a long journal entry. We're just going to worry about doing what we need to do to make these accounts 0. The next one, depreciation, $1,000. We're going to credit it $1,000. The next one, insurance, has a debit of $1,000. We're going to credit it to $1,000. The next one, telephone expense, has a debit of $1,100. We're going to credit it $1,000. Now we'll go ahead and worry about, well, how are we going to be in balance here? So we've done that. We've credited all these. That's going to make these all go to 0, but now we need to be in balance. So in our 4-step process, we're going to use the same account we did in the first journal entry, closing out to the income summary, this clearing account, this account which is kind of made up to just be a holding account during this closing process. Ultimately, it's going to go to retained earnings, but we want to put it to this clearing account. So here it is, clearing account, the $21,009, which of course will be the adding up of all the expenses, $6,005 plus $1,003 plus $11,000 plus $1,000 plus $1,000 plus $1,100 will add up to the debit of $21,900, putting us in balance. So what I'm going to do now is what I tried to explain at the beginning. I'm going to post this to the outer column. And the reason I'm going to do this is just so that this number you'll see has already got something in it, and we would have to change that. So I'm going to post it to the outer column, and then when we see the next slide, I'll show how it would all be in this inner column here if we posted all these journal entries to the inner column. So in other words, this is where we ended up last time, this outer column, after this first journal entry. If we did the adjustment here, I'm going to say, okay, this 6,005 credit 6,005 brings us to 0. And then we're going to post this 1,300. So the 1,300 credit will bring it to 0. And then we're just going to post the supplies, 11,000. So 11,000 credit 11,000 brings it to 0. And then we're going to have the depreciation, 1,000 credit 1,000 brings it to 0. And then we've got the insurance, 1,000 credit 1,000 brings it to 0. One more time, the telephone expense, 1,100 credit it to 1,100 brings it to 0. And then the other side is going to this income summary account. So that's where the tricky thing is. That's why we're not posting to the inner column here. I'm just showing you in the outer column because this number would have to change, right? This number is now going to be the net of these two numbers. Or in other words, this is the 29,000 that we were left with last time. And then we're posting this 21,900 to it. And the difference is going to be that 7,100. So this is the activity from these accounts after this journal entry. And the reason I'm posting it out here is just to show the fact that this account here is going to have two things that are going to happen to it. So what I'm going to do now is pull all these into the inner column where they should be and combine these two journal entries. So if we go to the next slide, we see that 7,100 is from this number and this number. So in our worksheet, in other words, this is being combined by these two numbers, creating this number and this number. And these are made from closing out revenue to the income summary, closing out expenses to the income summary. And this is where the point of the income summary comes into play. We can say, okay, why are we doing the income summary? Why didn't we just close it out to the retained earnings? Well, one, we can say, well, it kind of gives us a check figure. How does it give us a check figure? We can say, before we close it out to retained earnings, we want to verify that that actually adds up to net income, this number, and the number that should be on the income statement, because that'll verify that we got everything as it should be done. And we also want to verify that all these accounts are 0. All temporary accounts, all income statement temporary accounts are 0. Once we've verified those two things, we can kind of finalize that part of the closing process, which we'll do next time, which will be closing out the income summary, which has now net income in it, to where we really want to put it the whole time, where we see it on the statement of owner's equity or the statement of stockholders' equity, which is retained earnings. So that's what we'll do next time. For more accounting information and accounting courses, visit our website at accountinginstruction.info.